Good morning everybody and welcome to the Brexit Reaction webinar. Thank you ever so much to you all for taking the time to listen in. All I can really say so far is what a morning. It's been unprecedented. There's going to be a lot of uncertainty, a lot of questions, and really we wanted to help you be on the front foot with the questions you're going to get and help you communicate with your clients. Today's agenda, Chris Darbyshire, our Chief Investment Officer, will discuss our thoughts on the results, what's happened since the results, what's really going on in the near future. We're going to be talking a bit about how we've been positioned in the run-up to today, and of course how we're going to position ourselves going forwards. There will be a section for questions at the end, and I anticipate we're probably going to get a few through. So if I can just direct you to the slides on the screen. I've put a quick snapshot on there. You'll see a question functionality through the GoToWebinar software. If you just open that box out and simply type a question there, I will get that through on the laptop that I'm using here, and we'll be able to address those at the end. If you prefer to ask a question in good old-fashioned email, we do have an email address set up, which is webinars@7im.co.uk, and we'll also be receiving those through. Any questions we don't get to today, because of course we'll all be very busy and we won't want to keep you all morning, we will endeavour to answer and come back to you a little bit later on this morning. I guess that's really all for me to say. I'll hand over to Chris, as I said, our Chief Investment Officer. So Chris, what do we make of the morning?
Well, morning everybody. Yes, let's start with yesterday when we had the big move up in the betting odds. So yesterday actually there was a sudden lurch towards Remain in the betting odds. And we don't really know why, but we think it may have been connected with evidence of a strong turnout for the referendum, as the conventional wisdom was that the higher the turnout, the more likely we were to Remain. Well, the pound rallied to $1.50, and we had a big move up in stock markets yesterday, but that proved to be far too complacent. So what happened? Well, my team and I were in during the night. We had the first results coming in about 1:30 in the morning. Sunderland was one of the first constituencies to report, and it came in with a bigger leave vote than expected, and immediately the pound took a hit, falling to 143 from 150, so a big move. And I've got a note here on my notepad from that time saying, are we in for a rocky night? And we certainly were. By 2 o'clock in the morning, the betting odds had fallen from 90% probability of Remain to 50-50, and the pound was now hitting 140. Then at about 20 to 3 in the morning, suddenly we began to get a good series of votes for Remain coming through, mainly London-based results. Stocks surged, the pound surged back up all the way from 140 to 146, almost back to where it was at the beginning of the evening, and the betting odds very quickly came back to 60-40. This didn't last long. By about 3:15 we began to see leave momentum coming back the same way it had at the beginning of the evening, only this time it was too late. Enough results had come in that cumulatively it became quite unlikely to overcome the deficit. And by 3:45, so really just within 30 minutes of that momentum coming back, it was all over. The pound was in free fall, eventually troughing at about $1.33. Stock markets around the world were collapsing, and the betting odds had gone to a 90% probability of leave. Looking back on it, I'm sure there will be better analyses after the event. But what seems to have happened was that London met expectations for the proportion of voters choosing to Remain, but nearly everywhere else swung towards leave relative to the expectations going into the referendum. And the best sort of single reason that I can give is really concerned with the Labour Party. And it seems that the Labour Party did not get the vote out in their key constituencies. So in the Labour heartland, particularly in the Midlands, for example, there was not a high turnout. And when there was not a high turnout, the leave votes tended to dominate. And that seems to be the one factor around the country which was responsible more than any other. So what's next? Well, expect a big political response on both sides of the channel. I think there will be an attempt to calm things I think we've had our UK political shock already, so David Cameron is going to resign, though he will be staying as caretaker Prime Minister until a successor is found. And of course, given that it was the Labour Party that didn't really get the vote out, they are being held responsible, and Corbyn is being held responsible for the result of the vote. So I think he's now got a rearguard action himself to justify his role and the Labour Party's role in the referendum. And UKIP are talking about doing to the Labour Party in England what the SNP did to it in Scotland. So the future of the Labour Party is strangely, as a result of this, very much in doubt, as well as the future of the Conservative Party. So big shock to UK politics. The EU, of course, has to deal with the UK's departure from the European Union. Will likely call an emergency meeting, perhaps this weekend. If not, there is already a summit scheduled for later this month, next week in fact, at which the formal exit process can begin. Now the EU is caught between two stools here. On one hand, they'd like to make an example of the UK and to deal with us in a tough way, to send a message to anyone thinking of going down this route that it's not a good route to go down. But on the other hand, I think they want to emphasise stability and the rule of law and the fact that the current arrangements in place do go on for a couple of years. And I think it's the desire to emphasise stability that will triumph, certainly in the short term. So I see calming statements being made by the EU to begin with, and perhaps getting a bit more aggressive when the real negotiations get going. UK economically, well, there's a great deal of uncertainty here. Businesses will certainly hold back from investing. No doubt UK businesses will, but really international businesses based in the UK now have a real problem. And some of them will be looking to extricate themselves. So I think you've got a great deal of uncertainty in the UK economically. We've got potentially, lending costs rising in the UK. Import prices will rise simply because the pound is weaker, and we are very large importers of goods in the UK. And of course, when inflation rises, unless wages rise at the same time, household spending power does get squeezed. So that big part of the economy, which is consumption and consumer-driven, may hit a bit of a roadblock. So I think there's a real potential weak spot there. In Europe, the problem isn't economic, it's really political, and I think the attention of the world will actually turn away from the UK and towards Europe, where you've got referenda now being threatened in other nations by anti-Euro politicians, where you've already got fear of the rising tide of populist parties. In Italy recently, we had a populist fringe party win some important mayoral elections in Rome and Turin. We've got a Spanish general election on Sunday where the mainstream party is expected to win. Does the result in the UK embolden the populist parties? Does it upset the apple cart in Spain potentially as well? And of course in Europe we have this series of general elections coming the next 18 months that really covers 90% of the region. So I think attention really is going to turn much more to the future of the Eurozone and to the future of the European Union itself. Okay, so to immediate things, what is the impact on markets and what's the impact on our portfolios? Well, we did have the biggest ever one-day move in the pound yesterday, and I've put this on the chart here, and you can see here it starts the night at 150, and the time I did this chart, it dropped down well below 135, and that's about a 10% decline. To give you an idea, the pound fell by about 4% in 1992 when the UK was thrown out of the European exchange rate mechanism. So we're talking orders of magnitude greater than anything we have ever seen in sterling. And there are implications for our portfolios. Now we have intentionally a large number of foreign currency exposures in our portfolios. They come from holding foreign stock market positions, they come from holding foreign bonds. So we reckon about half of our portfolios actually were up between about 5 and 8% during the night, due simply to weakness of the pound. So that would have been a positive for our portfolios. Now, of course, the pound itself has implications for the economy. Just staying with portfolios for a second, and just thinking about our balanced portfolios here, you've got about just under half of those portfolios in equity, so in stock markets at the moment, and they fell dramatically around the world. In fact, one of the most volatile days in the history of capital markets, as Europe opened down about 12%, it's currently down about 9%. UK, so your FTSE 100 is down about 5%. UK smaller companies actually down about 8.5%. And the US stock market is down currently about 3%. And actually emerging Asia has been the best performer overnight. Those markets are down between about 2 and 3%. So you've got that part of the portfolio going down, but that's offset largely by the currency movement and the foreign currency exposures. At the same time, we've got a rally in the safe haven assets in the portfolio, so our US Treasury holdings, which we put in place earlier in the week, done very well overnight. The US Treasury yields are near all-time lows, had a big move during the night. Gold, which we put in place a few months ago, really with Brexit in mind, up 4% overnight. And we've got other alternatives that we think will work well, but we've yet to wait and see what the NAVs of those are. As a result, we think the portfolios will be marginally down overnight, possibly 1% in the case of balanced. It might actually be as good as being flat. So our emphasis has very much been on preserving capital, in advance of this sort of very difficult event and risk managing the event. And how did we do it? So just final slide here. We really prioritized foreign currencies as our risk management tool. So here's a slide. On the bottom of this slide, you've got our asset class exposures. And you can see within that horizontal chart, you've got lots of foreign exposures, European equity, emerging markets equity, emerging market bonds, and so on. So there's lots of foreign currency exposure there. And then looking at the top part of the chart, you've got our foreign currency exposure. And what I've done is I've highlighted where the pound might have got to if we remained, which was $1.50, where it was last night when the betting was so in favour of remain. And we thought perhaps 125 is where it gets to in a leave situation. We're not quite there yet, but we got close to that. And that was really, those two extremes were the problem we had to face. And what we did was we used our foreign currency exposure to manage the problem. So if you look at the dotted line on the top part of this chart, you can see our strategic or our neutral position would have been about 45% in foreign currencies, so about 55% in sterling. From late March until June last week, we were running a significant underweight to sterling, so increasing the foreign currency component up to about 65% in anticipation of fears in the run-up to the referendum. And those fears came, and then at the end of last week, we had a change, it appeared, in the voting intentions. We had the murder of Joe Cox, the politician, and that seemed to send the probabilities back the other way. So that we then moved our sterling position up a little bit and our foreign currency position down a little bit. So you can see those kind of grey lines moving towards the left as we're trying to respond to the changes in expectations for the referendum. And then our last move, which is the very dark line there, was last night, sort of about 3:30 in the morning last night, when it looked like, it really was done and dusted, then it was going to be a leave vote. We then took a bit more actually US dollar exposure, moving our portfolios to about half and half, so half sterling, half foreign currencies. And this has been a very effective tool. Over the last few months, you'll have noticed that the portfolios have been very stable indeed, even up to and including last night. So, very pleased that the tactical risk management worked well. I'm very pleased that our strategic asset allocation does enable us to do this through the foreign currency exposure. And what we've done here is what we would always do, what 7IM will always do, which is prioritise protection of your capital when we have a real roadblock coming, something that is very tangible and something that we can, react towards with a high degree of reliability.
Excellent.
I will leave it there.
Thanks very much, Chris. Okay, so as mentioned, we have time for questions, and we've had a few through, but please do keep them coming. If we don't get a chance to answer them on the call this morning, we will come back to you with answers. And I should add, if you're listening later on today, i.e. not live, we will take questions on our webinars at 7im.co.uk email address. Chris, the first question I've had through, and I think it's a very valid one, I think people have been, or rumour has it, people have been kind of withholding investment and deciding that actually I'm going to kind of wait and see the outcome. Given what's happened, are we now in a place where actually it's a good time to invest? Or should people wait till tomorrow, Monday, next week, or are we not there?
How are we feeling? So I can answer that by answering how are my team feeling about investment, and I think we would like to let the dust settle a little bit. This has just happened. We don't know the extent of the economic impact in the UK. We don't know the extent of the political impact in Europe yet. So we are, we can see that there are some opportunities developing out there. We're beginning to discuss, should we buy a bit of UK FTSE 100? Should we buy a bit of high yield? We're beginning to see opportunities. But I think we may move. It will be probably in a few hours, or possibly a couple of days' time. But before I think we feel confident to go in. There is a great deal of uncertainty. I think a lot depends on your point of view. If you voted to leave and you're relatively comfortable with that, then I think you've kind of taken the decision that things aren't going to be terrible, and then I think you can go ahead and invest. That's really what the vote was all about. But I think our job is to read the markets as well as the economy, and the markets are looking pretty volatile and are giving us a different signal at the moment.
Excellent. Okay, thanks, Chris. I've had a couple of fairly related questions, Chris. So a question on the effect on residential property, and I guess that leads into another question that I've had, is how is Brexit going to affect lending for mortgages? Something that was clearly catastrophic after the 2008 situation.
Yes, I'm a bit concerned about the property market to the extent that it is influenced by foreign investors. And I think so really you're sort of, upper end of the UK residential property market, of course the commercial property market. These are, I think, exposed. And I think there will be foreign investors. They'll want to pull the money out because the UK is no longer maybe such a stable environment in which to hold an investment. At the same time, of course, the pound has fallen a great deal, so these properties are now cheaper. So I can see there being two opposing forces there. But I am concerned that this huge flow of Italian and Greek and Chinese and Russian buyers into the London residential property market will dry up a bit. Mortgage lending, well, of course, the banks won't lend if they think that those mortgages are becoming more risky. And I think the banks may well withhold lending until they see the economic fallout in the UK from this. And there will be some areas where you have a large preponderance of foreign firms, maybe large factories that have been put in the UK by foreign firms who hope to access the European market, where as a banker you're thinking seriously about whether that factory is going to be there and whether you should be lending at all in those areas. So I think, yeah, there probably is a pause in mortgage lending.
Interesting. Thanks, Chris. Next question, given the conversations around currency this morning, I have a question here. Do you think the pound may strengthen against the euro in weeks to come when the future of the EU looks perhaps weaker as more countries consider their own referendums?
Yes, I think that's a real possibility. I think the focus of attention does shift from the UK and the pound towards Europe and the euro. And the euro has been pretty strong against the pound. We are not currently holding any euro exposure at all in the portfolios. So we've relied on the dollar overnight rather than the euro.
Excellent. Okay, Chris, will we continue to favour safe havens such as US Treasuries and gold, etc., for the long term, or do you think these havens have already been priced in?
Well, I do think they have moved a lot overnight. I can see us still holding them certainly in the short term, but there's no doubt they've become a lot less attractive if markets begin to relax about this problem, about Brexit and about the implications for Europe. Then I think you're going to see a fall in the value of those asset classes. Having said that, they did prove their worth last night again to us. So I don't think we'll be getting rid of them in a hurry.
Excellent. Chris, another question here. Clearly we can only really talk from our own point of view here. What really happens to those UK-based investment managers that perhaps haven't looked at currency? Effectively, what are we going to be saying to clients who not only invest with 7IM but perhaps invest elsewhere as well?
Well, I think if you're a UK manager that hasn't really got the ability to flex your foreign currency exposure, you're relying on simply being in or out of assets, and being in or out of the stock market really is the alternative to trying to use currencies. So unless you took a kind of a view that Brexit was highly likely to occur and withdrew from the stock market and had a high cash position, you're probably going to pass through quite a bit of the market volatility today to portfolios. So I think there's no way you can avoid that. I think the message is you've got to have more tools in your toolbox than just cash or other assets. And I think the other thing that I've really learned over the past few months is it's good then to use the tool that actually reliably works. We could have tried to reduce UK stock market exposure, but it would not have worked as reliably as currencies. In fact, the UK stock market's been pretty solid over the past few months. It would have been the wrong approach to use. So you've got to have tools in your toolbox, but then that's not the end of the story. You've got to pick the right tool.
Absolutely. Okay, another question. Here we have a question on what we think might happen to corporate bonds and whether we think interest rates may rise in the near future.
Yes, it's really interesting. There has been some interest in corporate bonds this morning. The spreads did blow out a little bit this morning, and you were able to buy some of these pretty safe corporate bonds at yields that you really haven't been able to access them at for a long time. So I do think actually they've become a bit more attractive. I'm sorry, Jim, what was the second part of the question?
Interest rates and whether we think they'll rise.
Yeah, so the market expectations for rate rises has been pushed right out. So the market's reacting. I think the Bank of England has got a very difficult job now, because if the pound stays down, inflation will rise, and it will rise significantly. So I think from that sense, you don't want to, you want to keep the rate rise possibility on the table. On the other hand, that is a tightening of economic conditions if you do that, and this is not the time to be doing that. So I think it's a very difficult call on rates. I would not want to sort of put my money on the table right at the moment.
No, that sounds very fair enough. The next question, Chris. What do we think the effect of a ratings agency downgrade from AAA to AA or worse, the effect of that, and whether we might think that's likely?
Yeah, I mean, we lost our sort of across the board AAA rating in 2013, but of course at that time other countries were losing it at the same time. So this is, could be a UK specific problem. And I think it will impact, I think it does impact sterling. All of these impacts eventually come back to a problem for sterling. We've just had China join the International Monetary Fund's kind of special reserve basket for currencies. And here we have people who are now underweight Chinese bonds and probably overweight sterling. And I can see, therefore, there's a catalyst here for people selling government bonds, and so I do think there's risk there.
Okay, Chris, thank you. Next question. What might represent the best way for clients to take a positive medium-term position on sterling from here onwards?
Well, that's a good question. It's the question that we are asking ourselves, I think, more than any other. It hit 133 during the night. It's back up I think it was 137 when we came into when we started the webinar. You know, you've got this toss-up between, do I want sterling, you know, will sterling rebound if people begin to calm down? On the other hand, we've got political uncertainty, economic uncertainty, and market uncertainty. I don't think we're quite ready to buy sterling yet, but I actually also think that we're maybe, you know, if sterling is stable, you know, through the next few days, and all of the events and the policy changes and the, you know, the political statements that are going to be made, you can maybe argue it's hit bottom, and actually you can take more sterling exposure now. Hard to think to put a plan in place. It's going to be, the goalposts are going to be moving a lot the next few days.
Excellent. And this may well be the question I guess everybody's going to get asked the most. But so fair enough if we're still thinking on this. How long do you forecast it will take for markets to find its new level to kind of accept what's gone on?
Yeah, I mean, interestingly, they've bounced already this morning. So yeah, so they've already kind of come back about a third from the trough. So they do seem to be finding their new level. Now the US hasn't really, you know, woken up yet. So we're wondering on the team if there's another leg down. But I'm thinking probably anyone who was going to be a significant trader would have been up early. So that's probably unlikely to happen. So I think, you know, we've got a bit of stability at the moment. I can see that being knocked off course if the Netherlands, you know, suddenly decides to have a referendum. If France, you know, these referendums are being called for by the fringe parties in these countries. It doesn't mean they're going to happen. But if there was a bit of momentum behind that, you could see another leg down. And of course, we've got the Spanish vote on Sunday, which could also prompt another leg down in markets. So it's really just I think it's the political risk problem in Europe that is going to be the focal point.
Indeed. Okay. Any thoughts specifically on commercial property in the immediate to short term? Yeah,
well, you know, commercial property in the City of London, that just the two terms go together, and I think it's very hard to be planning, you know, development projects in the City of London. I think if you've got a development project on the go that is, you know, not coming to fruition for a few years, you're going to have to be reducing your expectations for demand and so on. So I think it's got a very difficult time ahead of it, and it is of course a notoriously illiquid market. So we could see some gating of funds and some extreme volatility in that market.
Okay. I guess we're coming just probably about to the end of where we were. Thank you ever so much, everybody, for your questions. We will, of course, as I said, come back to those of you that we haven't got to. I think possibly final question, and hopefully this will be the one that everybody finds the most helpful. Chris, what advice really should our key partners really be offering their clients with investment portfolios right now over the long term?
I think, look, long term, you don't panic. You stick to your plan. You know, events like this will happen. They're part of the evolution of Europe towards a better arrangement. And I think what the vote today says is, look, Europe is just not that democratic a place, right? You've got laws being made at a very senior level that really don't reflect what the populations want. And long term, that's not a good thing. So long term, it's good that we get this debate. It's good that we put these things in the open. This is not, for me, the end of the world. I think you've got a market sell-off in the short term. I think it's less an economic problem. And what happens is, over time, the data will show that it's not an economic problem, certainly outside of the UK. And the political authorities will try to manage the political risk. So I can see, you know, us getting more calm. So yeah, long term, don't panic, stick to your plan, keep putting your money into the market, and you know, these ups and downs even out over time.
Excellent, thank you, Chris. Well, I hope we've been able to offer some guidance and some sort of immediate reaction to the results, and I hope you've all found it useful. We will, of course, be at the end of a phone today. We'll be being as proactive as we can with information as and when it comes through. We'd be delighted to speak to any of you. We can only offer our support and help from our support desk. So You will have your 7 AM contact details. Don't hesitate to get in touch. I really can't stress that enough. Chris and the team will be working and keeping us informed, and we'd love to be able to pass that information on to you. In the meantime, I do hope your clients are able to settle into the day and kind of take the news, and you're all equipped to deal with the questions that come in. Thanks very much, Chris, and thanks very much again to all of you listening in. Thanks.
Bye-bye.